Let's start with gold. It is the most popular commodity on this channel. Some would call it a monetary metal and not a commodity, but we'll call it a commodity today. Now, we all know the story, gold at nominal all-time highs. However, it's been consolidating for quite some time. We've seen it dip a little bit recently. I don't think this is anything people need to be alarmed about, but I'm wondering in both of your opinions, are we due for a breakout or a breakdown? And Patrick, I'll start with you.
Oh man, I was sure you were going to choose Kevin. I was going to take it easy, just chillax. So, all right, fine, okay. You want to do it the hard way? I'll let the charts do the speaking,
Yeah.
and I'm sure Kevin's going to put some color commentary on that. So, your first question: people, they're in gold, stackers. Okay, they don't care about price, but um, you're a trader. Some people either they got in Jesse here at the beginning of the bull market back in June of 2019, or some people they bought during this consolidation, or they bought on the breakout here in on the close of November. This is a monthly candle charts, guys. So every candle has 1 month of data, and people are just writing it go up. And gold has been a beautiful trade because it's just been trending nicely above the 12-month moving average. Not much worries or stress, and just kept going up and up. Now people are saying, well, okay, what's happening here? Is it, are we done at the end of the road? Well, I could answer that in two ways. One way is the classical TA way, classical technical analysis. So you have measured moves, you have a pull, flag, and then got a pull. You add that measured move, and usually that's the energy into the pattern, compress, 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 moving averages. They tighten up. Nobody believes in gold anymore. It even did a false breakdown here, scaring everybody. And look at what it did. So now, from a classical TA perspective, gold has reached its target around the 3K. It's done. So anybody wants to know, like, but these measure moves off, they could overstretch. Sometimes they undershoot, but most of the time they hover in that area. So while the price did shoot up, guess what happened? Not too high above, guys. The price went sideways. So from a TA perspective, it's a classical TA, it's stretch. From a trend analysis, that means I'm using a moving average. Look at that 12-month moving average. I haven't closed below it any yet. So it's still an uptrend. People could still be riding this since late November and say, I'm only going to exit once I lose that trend. So to answer your question, how are we about to lose that trend? Well, here you could look at the distance from the 36-month moving average. So the bottom pane is the distance from that red line. And look at it. I'm going to show you historically. We're an outlier situation right here. This is the 70s. The 70s. Here's 2006, 2008 before the GFC. Here's the 2011 before the huge bear market. Here, it couldn't get that high on the previous rally. Look how stretched it was. It was crazy FOMO here, and people were getting upset at Kevin and I on April, where we're telling people, guys, hold on. We're not telling you it's the end of the ride, but we're telling you that we're stretched. So while people, they want to jump in April, the time to jump in wasn't in April. The time to jump in was June of 2019 and December of 2023. If you miss those entries, I'm sorry, you missed them. You can't, I can't create low risk entries for you. So we're stretched. But now, as months has gone by, check it out, Kevin. The momentum is slowing down. So the price, as it's going sideways, the rising moving average, that 3-year moving average is catching up. I'm going to highlight it for you guys real fast. So the price wants to catch up to this, and that's this line. If we close below this valid rising trend line here, we are in a monthly defined correction. So right now we're going sideways. There is we're having a hard time here at this level, guys, at the 3,325 level about, or maybe a little lower. We're having a hard time getting above that. If ever we close below that line here, so the price is not able to reaccelerate, it's 100% correction mode. And now you could be looking at something more nefarious, a retag of the rising 12-month moving average, which is at 2,925. And if that fails, then you could even expect a retag of the 3-year moving average inclining eventually. And that will create the next low risk entry. So as this goes down, it creates the next breakout line. You see right here, when you're coiled and tight to the moving average, will be the next low risk entry. So I hope I answered your question. Is the correction going to continue? Well, it's getting really close right now, but we're just stretched. It's like, what can we tell other people, Kevin, there? Another way, maybe another analogy to help people understand where gold is at there right now.
The copper market, of course, is the biggest metal market on the planet, 2 to 300 billion globally of metal traded. Following majors around and picking up projects that they jettison can lead to great success in this business. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
Well, yeah, I mean, as you said, the elastic band is stretched, so people can get angry with us for not being able to identify a low risk entry point here. But as you quite rightly said, you do not find low risk entry points when the price is stretched from its long-term moving averages. So it depends on your methodology and it depends on your mindset, whether you're a short-term trader, a long-term investor, or a stacker, as to what you do at this point. But clearly, there is a significant risk, a significant threat that the price of gold is either going to go sideways in time to get closer to that moving average, or it's actually going to be pulled downwards in direction to close up that distance with the longer term moving averages. Now, I know some people will be looking at this saying, well, yes, what about the 1970s? You can see that the distance from moving average went much, much higher. And if it does the same now, it'll just ignore what we're saying and the price will keep going up. Well, one thing to say about that is if you're an investor and you're invested in the gold market, that's great. No worries. We're not telling you to sell as an investor or a stacker. There's no reason to do that as long as we're in a long-term, well-defined precious metals bull market. So if you have long-term positions, should these short-term corrections are, it's not a point for selling necessarily. It's a point where you might want to consider taking an opportunity to add at a reduced rate. That's very different to a trader who doesn't have a position in gold and who wants to take a short-term position in gold. So, as the question that you asked, the way that you answer it and how you tackle it depends very much on your own mindset and your own risk attitude and all that kind of stuff as well. But we cannot, as Pat said, we cannot create low risk entry points. This is not a low risk entry point, but it does not mean that the price of gold isn't going to continue grinding upwards. It could very well do that, and we could be in some kind of completely different paradigm where the price of gold just goes on up to $10,000, $12,000 without any significant corrections. But the probability of that is low. And as traders and investors, what we try to identify is what is most likely. We're not trying to identify what will happen, because we have to accept, however clever we think we are, we don't know what will happen, but we know what is most likely to happen by studying history and by studying the relationship of gold and silver and gold to the US dollar and gold to the stock markets, all of these interrelationships. We can work out what's most likely to happen. So what's most likely to happen at the moment is that we have an extended consolidation for gold, or we gradually start to move into a corrective phase.